Take notes. I think I gotta get ready.
Want us to
Yeah.
make our way up
Right.
there?
Yeah.
How am I going to come back to my next life as a rock star? I don't know how to use a mic. Thank you guys for coming tonight. This is our, I don't know, 6th or 7th annual State of the Markets event. I lost count of how many we've had so far. For those of you that might be new joining us tonight, who I am, Kathy Nolan. Sean Nolan, my partner and son, is live streaming down in South Carolina with a lot of our clients that moved down that way, or some new ones that we've met down there. So he's got a little live stream going on at the office there. And so hi, Sean. I know this is on delay, but you probably can hear us. So tonight we have some special guests with us, but before we get into that, I just wanted to comment on a couple of things. I know so many people are retiring this year. This is wonderful. This is like what we do. You know, help you get there, help you to retire, live a good life. So I'm so happy to hear that you know, you're going to be at that stage and you're going to be able to travel or whatever it is that you enjoy doing. Maybe go out to eat more, play more golf, more tennis, more grandkids, whatever it is that you enjoy. So it's a happy time. So enjoy it as best you can. We're all about you having fun. You should know that by now, right? Definitely. Just a little comment. Last night, you know, we have a new president. So some of you are happy, some of you are unhappy, but it's all good. It's all good. I remember, it reminds me of a movie that one of my favorite movies of all times is My Big Fat Greek Wedding. If anybody ever saw that, it's like probably my favorite movie of all times. And Gus gets up there at the wedding and he says, you know, portcullis, that means fruit. And what was the other guy saying? Miller, that means apple. He says, but we're all fruit. So we're all fruit. I probably didn't deliver that very well. I'm telling you. So I should quit my day job. Stick with the rock star. So just a little comment now. You know that we're very proactive talking about taxes. We've been very proactive about this for many years, and even more so now. And so what I will tell you is, regardless of what we've heard from any politician, we do think that there is a possibility that these, they call them the Trump tax code, but the tax code from 2017, we think there might be a possibility it may be extended. Okay, it may be extended a year, maybe more, who knows? But what I will tell you is the freight train is a coming. Okay, so don't get complacent about continuing to do your tax planning, because it's coming at us like a freight train. We have 36 trillion with a T dollars in debt, and mounting every single day. Last year we spent we took in 4.7 trillion in revenue, mostly from independent taxpayers, right? Small businesses. We spent 4.7 trillion just on Medicare, Social Security, and servicing our debt. Spent it all. What does that mean? It means that there needed to be more money for education, for defense, for infrastructure, you know, technology, all the other things that we still need to do, we still need to spend money on. And so these are all the things that Congress gets to fight about, back and forth, back and forth. So they're going to be spending money on these things. They have to. You know, we have to remain the greatest country in the world, right? And so the tax problem is not gone, regardless of what anybody tells you. So I would continue with your tax strategy, and if you need a review of that, you know, please talk to us, come see us, because you need to follow through with that, and even more so. We called this, we had a webinar today with one of our colleagues, Becky Swansburg. A lot of you may have met her when we did a workshop about IUL and tax strategy and whatnot. She's come to Jersey and South Carolina a couple of times. And she worked in Washington under the Bush administration on tax policy. So I really respect her opinion and her knowledge of how things really work in Washington. And she said 2025 should be the year of the Roth conversion. All right, you don't know how much more time you're gonna have with that. And there's other ways to handle the Roth conversion too, as some of you know, which we're doing. But don't stop that freight train, because you really want to put yourself in a position where you're going to have more money tax-free later on, and you're going to need it. Our retirement doesn't last 4 years. It doesn't last through one presidency. It's going to last maybe 20, 30, 40 years for some of you. So we still need to plan like we're going to be here for a long time, and you want to be able to keep as much of your money as you possibly can. So we're very big on tax strategy. So if you have any questions about that, or you haven't really embraced that planning, please do so, because you're going to be very, very happy down the road that you really took that advice. I do want to introduce a new colleague of ours. We have Rich Osmond here, this tall guy. Come on over here, Rich. We have this little tall guy in the back. I look like a little tiny top tall. But,
Just a little bit.
Just a little bit. Rich had joined us a couple of months ago, and he was actually a friend, or is a friend of Sean's for many years, through their kitties. And Sean's been trying to get Rich to leave the mothership of Merrill Lynch and come on board with us. And he finally saw the light and joined us a few months back. And Rich will tell you, if you meet with him, that he was not allowed to do the planning that we do. He was not allowed to talk about estate planning, or allowed to talk about taxes, or allowed to talk about Medicare or IRMA tax or any of those things. And how do you plan retirement without talking about all that stuff? We have that green light retirement plan that we came up with, and Sean wrote a book on it if anybody wants a copy. And it's all about lifestyle, income, growth, healthcare, heirs, and taxes. It's a 5-step, step process. And we need to cover all the steps. So Rich is really enjoying being able to do some new things that he was restricted, from doing for many, many years. I do want you to know that I have assigned to Rich a lot of our clients, because I'm not leaving you. Okay, so don't get nervous. I'm not giving you away, but I realize that I need some help. Okay, I want you to continue to get excellent service. We have a wonderful team in New Jersey, and now we have somebody new down in South Carolina, Bridget. She's cute, she's helping Sean down there. But, I try to be in many places and, help as many people as I can. But, I want you to continue to get that good service. So don't feel slighted or feel like I'm giving you away. But Rich is going to be doing some of these reviews and these service appointments. And he's he and I always collaborate. We take a team approach. So whether it's me and Rich, Sean, Brian, we take a team approach. So every Monday, I don't know if you know this, we have a powwow every single Monday, and we go over all this stuff. What's going on this week? Who did you see? What was going on? How can we help them? And we give each other a lot of feedback. You have the old age wisdom over here, I like to say, and then you got the fresh young blood over there with Sean and Rich, and it's a really good combination. So we kind of feed off each other. So I want you to know that, we're 100% committed, we're here to stay, and we want to continue to offer you the great service that we always have. And we appreciate all of you and appreciate you all being here tonight. So I wanted to introduce you to Rich. You may hear from him in the next few weeks, just to say, hey, time to get in here and do a review. I need to check your beneficiaries, things that, we should really be doing on an ongoing basis, just to make sure you're in the right position that you need to be in, okay? So there's Rich. Thanks, Rich.
You're welcome.
All right.
And
They all know they put me in front of a microphone. I don't know, some of you know this and some of you don't. Sean and I made a movie. See, a lot of you don't, because you're going, oh. Some of you have been to the movie. It's called The Psychology of Retirement. We are the executive producers of the movie. So we were offered an opportunity to produce this movie about retirement. What I love so much about the movie is Sean and I just recorded, we did a trailer in the beginning, and we're not in the movie. No, seriously, in the movie, you have the New York Times best-selling financial author, Morgan Housel. You have the former comptroller of the Treasury. You have former director of Social Security. You have leading economists. So you have everybody in the movie that, has a lot of credibility. It's not a bunch of financial advisors, spewing things at you. It's strictly a lot of third-party professionals with a lot of knowledge, more than I have, that are in the movie. And we've gotten an excellent response from the movie. We will be showing it again here in New Jersey in January. We've done it, twice here? Twice here in New Jersey, and the second one in South Carolina is next week. That we'll be doing it, and every time we've done it, the theater has been entirely full. So if you want to come to the movie, make sure that we reserve you a seat, because of course we'd like you to see it. You also have an option of having your own watch party. So if you don't feel like going to the movie theater and you want to have your own little watch party, we have live streaming cards that we purchase that you can watch the movie in your own home. And I would say have a bunch of friends over, family, coworkers, get the popcorn, and have a little party of it. You will love the movie. It's very, very well done, and I think you'll really get a lot out of it. And that's called The Psychology of Retirement. And if you want a streaming card, speak to Hunter. I have clients that say, people out of state, like, well, how do I reach my brother down in Virginia? Or, I have a sister down in Florida. They can watch it, they can live stream it, if they want to watch it. So we do have exclusive rights to the movie, and you won't see it from anyone else. So we thought it was really important to participate in that. Okay, so that's the movie. The next thing is there's something, it's our fault. We fail to tell you all the things that we do for our clients, only because we don't want you to think that we're just, blowing smoke or whatever. We have a program, Rich didn't even know about it, that's how bad we are. We have a program called Tuition Rewards. And it's a program that we pay for, it's through Sage Scholars. And what it is it's actually a program where we award points to you as a client for your, the accounts that you have, for your loyalty, for every time you attend an event. And it could be a barbecue, it could be a party, or it could be something more business-oriented like this. Every time you give us a referral, you're awarded points. Now, you accumulate these points, and they can be used for any one of your grandchildren, nieces or nephews, any blood relatives. That would be a blood relative that is under 15 years old and under. So there's over 400 colleges, private colleges, that are in the program. They add more every year. And so basically what they do is they apportion these points once a child decides to go to their school. They get these points every year. So we've had some of our clients, it'll pay up to a year's worth of tuition in many cases. And it's free. All you have to do is register the child on this program. So you don't know about it, you want to get involved with it. I had 2 clients yesterday that don't have any children, and I know that their sister, their nieces and nephews, babies, I said, you could be in the program. They had no idea. So you don't have to have your own kids. If you have nieces and nephews that may go to college someday, because that is a daunting bill, as we know. Just give the office a call, either Hunter or Ashley will walk you through how to register. And then it's pretty seamless. We usually award the points every year, maybe at the holiday party or at some other event. And some of our clients have hundreds of thousands of points that they've accumulated that they're going to be able to use, and you can use it for any one of the kids. Okay, so that's that. And that's about it. So without further ado, we have 2 very, very special guests tonight. One of our guests is Ryan Vande Velde, and he is part of our AE Wealth investment team, and he's stationed at the home office in Topeka. And Ryan is awesome. He helps us with any questions that we have about, portfolio management or anything having to do with investments. He's there to be our guide with all of that. So he was here last year, for those of you that might remember him. And then we also have a very special guest. We have one of our actual portfolio managers that is here tonight. He had plenty of meetings in New York City today, and Phon is going to get up tonight and tell you a little bit about some of the strategies that he has. And we've used a lot of his portfolios for our clients, and he's doing an excellent job. So he has a different kind of way of doing things, and we think that you'll find this talk very, very interesting. So we're happy that he was able to join us tonight and give you some insight, and maybe you might think about utilizing some of the strategies that Phon has for us to use. Anything else I forgot? I think that's it. So without further ado, Vande and Phon.
Thank you, Kathy. I got you. I got you. Got you. Oh. Thank you for those kind words, Kathy. Can everybody hear me okay? Is it pretty? Well, we got. Do we want to hand it back and forth? I can get loud if I need to.
We can't use the mics because it reverberates in the YouTube thing, so they won't be heard down south. So it's either that mic
hand it back and forth,
or big mouth mic.
Okay. You want me to take it? We can kind of hand it back and forth, or how you want?
I can yell. Yeah.
Well, I don't know. Here. I'll yell. I'll yell. I'll raise my voice. So, first of all, just thank you all for coming. We know you guys could be spending your time other places, so we really appreciate you all coming to the event, listening to us. We hope you take away some ideas. So what Phon and I are going to do tonight is we're going to do a little bit of a recap of this year, talk through what's happened in the first 3 quarters of this year, what's transpired, how we got to where we are, and then maybe give you guys some ideas, some thoughts, some things to keep an eye on as we go forward through the end of 2024. Before we do get started, my compliance team would be very upset with me if I did not disclose this disclaimer. None of this up here is investment advice or recommendations from us. This is purely educational and informative. So at least we hope you find it informative. So from there, I'm going to do a little bit more of a bio real quick on Phon, our special guest here. So he started his career in 2000 as a bond analyst and a portfolio manager at Principal Global Investors, actually in Sydney, Australia. And then in 2008, he joined a Saudi Arabian bank as one of the top proprietary trader overseeing multi-billion-dollar portfolios through the financial crisis. He's also led risk management and derivative teams at major insurance companies, and then started his own firm here in 2019, Veta Investment Partners. He is the CEO and founder of that firm, and currently manages right around $5 billion in assets, some for insurance companies and some for wealth management platforms like AE Wealth. So, Phon, thanks for being here.
Thanks.
All right, let's go ahead and get right into this. So let's start at the beginning of the year. Markets were pretty strong. I mean, I would say when we started off the year, the S&P 500, some of the major indices were hitting all-time highs throughout the first quarter. One of the primary drivers, though, during that time really seemed to be what the Federal Reserve was talking about in regards to cutting interest rates. We saw that rhetoric in the headlines. At that time, Federal Chair Jerome Powell really made it sound like we would get up to potentially maybe 6 interest rate cuts up at that point in time.
Correct. Works.
Phon, do you mind maybe giving your thoughts on the Fed actions in the first quarter? Was it aligned with what was going on in the economy and the markets, or?
Sure. I think first thing I want to say is definitely thank you for your time. And I actually lived in New Jersey. I lived in New Brunswick, New Jersey, which is about, I think, an hour and a half north of here. So very happy to be back in New Jersey, and great to see everyone. Also, kind of go off a little bit off script, but Kathy and our team are probably one of the best teams I work with in terms of advisor groups. So I think you're in very good hands with Kathy and team. I've been working with advisors for the last 4 to 5 years. So just want to say that real fast. In terms of the economy and the Fed in Q1, as you recall, the Fed started raising rates pretty aggressively. As you know, mortgage rates went up to double digits. So in the beginning of the year, there's a lot of, I would say, optimism and a little bit of pessimism. A lot of people, including myself, were concerned about a recession potentially at the end of Q3 and Q4. But I think we'll talk about later. But the combination of AI and technology, and I think Kathy mentioned it, continued government spending and the strong U.S. economy the consumer, we kind of powered through. So that's kind of a quick recap of Q1. Yep.
Yeah, no, that's good. Thank you, Phon. That leads us into the second quarter, leads us up into April. And again, through the second quarter was still relatively strong equity market performance. We started again to see new highs from the major indices. However, a question that I get and Phon get all the time is around a company that most of us are probably familiar with, NVIDIA. Thank you. Yeah.
Yep.
And with NVIDIA, I mean, it's just a well-known name. The stock, if you're not familiar with it, it's a chip producer that a lot of other major tech companies leverage and use. But I was wondering, Phon, if you kind of talk a little bit about not just what that company does and how it affects the overall stock market, but how is it driving some of the performance, especially in Q2,
Sure.
around just the broader equity markets.
Sure. So NVIDIA is essentially, through all their hard work and dedication, they basically have the monopoly in these special chips that power AI and even crypto. I remember looking at NVIDIA when their chips were powering all the crypto farms, and then ChatGPT and AI boom, and they were the only company in the world that powered these chips. So you look at their earnings, it's like actually true growth. They made so much money in terms of revenues and profits that their stock had to expand, and they're like probably one of the largest companies in the world now. So NVIDIA is a legitimate company. It's true growth. I think AI in the long run is similar to the internet. It's going to help us and the economy. I'm aging myself a little bit. I'm not sure if you guys remember Cisco during the internet bubble. It's kind of like Cisco. Cisco is producing real earnings. So eventually, like all bubbles kind of collapse due to something. So as you know, that's the great thing about the U.S. economy. It's very dynamic. So eventually, in 5 to 10 years, there's going to be another NVIDIA that comes to surpass it. So right now, NVIDIA is good, but the beauty of the U.S. economy is it keeps innovating and growing. Do you have a question? Yeah, that's great.
Yeah, about it. So do you, because of what's happening in the Middle East,
Uh-huh.
I had heard that some countries were going to ban NVIDIA chips.
Yep.
Like, is that a real thing?
It is a real thing because they realize how powerful NVIDIA is now. So now a lot of countries are trying to create their own NVIDIA supply chains because it's essentially they know that the U.S. government can tell NVIDIA worst case scenario what to do. So then they're trying to prepare for that and create their own supply chain.
So what do you think is what do you think is going to be the effect of that?
That's obviously a small net negative to NVIDIA, but I think still the U.S. economy and the Europe economy, or like some other countries, are still growing pretty nicely. I think the biggest thing with NVIDIA, if a true competitor comes out, right now there's no true competition, so they'll still do okay. Does that help?
Yes, thank you.
Sure. That's good. Interactive questions. Questions are
I was
good.
gonna ask
Yeah.
you to
Okay.
hold your questions, so
Yeah.
I'm sorry.
Oh, okay.
No, that's okay.
Okay.
But
Sorry.
we will have a Q&A.
Yeah.
So if you want to write some stuff down, they're going to be here to answer all questions. Okay?
I'll chime in too. For those of you watching at home, you can chat in your questions on the chat feature through YouTube, and Brian and the team will get that up to us, and we'll hopefully answer your questions if we don't answer them throughout the presentation. So.
Yeah. Sure.
Yeah, absolutely. Absolutely.
Yeah.
Okay. No, thanks, Phon. That was good. So that leads us up into the third quarter. We're in August right now. And after the first half of the year just being overall pretty strong for the major indices and what we would say is a relatively calm year in the stock market, we did start to see some market volatility pick up, or at least we saw some headlines around, renewed concerns around recessions or geopolitical events, things that are going on in the Middle East, softening economic data, and much of the volatility, again, it keeps coming back to the interest rate environment. But during that time, the Federal Reserve finally, in the middle of September, well, a lot of the volatility was happening because a lot of investors like you all and us thought that they were delaying these cuts. We were really looking for that cut earlier than what we did. However, in mid-September, we saw the first interest rate cut since 2020, if you remember. The anticipated cut on the interest rate was 25 basis points at that time, or
Yeah.
a quarter of a percentage. And we actually saw a 50 basis point cut, or a half a percentage point cut, which is a big deal. I would say that's not typically common for the Fed to do that, but they felt it was needed and warranted. So it seemed a little bit like Jerome Powell and the Federal Reserve were telegraphing that they had come to an end, or they were fighting that inflation and getting it down to their 2% target at that time. And at that point here, now we get into the middle. We're still in September, getting towards the end of September. And we're seeing data like you see up here on your screen. In August, unemployment rate was at 4.2%, GDP at 3%, and then that inflation rate was at 2.5% then. I think it's maybe creeped down a little bit. But Phon, do you want to maybe give your thoughts on, that interest rate cut specifically? Was it warranted? Was the 50 basis points warranted? Or you have some thoughts around that?
Yeah, I was expecting 25 basis points, but I think 50 basis points was good. It kind of got ahead of some things. And also, I think they will never say it, but I think they're looking ahead to the elections, because I think they didn't want to have to be forced to cut right after an election and seem political. So I think they put the extra 25 in now. So I think they actually surprisingly did a good job, because you look historically, the Fed is always too aggressive and causes a recession. But they did a good job, decent job this time, surprisingly. So
Yeah. Okay. Oh, technical difficulties. Brian, are you able to? There we go. Hold on. Might have got it there. There we go. Okay, let's shift gears a little bit and talk about maybe some things to keep an eye on here throughout the rest of this year, and into the fourth quarter and into 2025. And this might seem like we're beating a dead horse here, but let's start out with interest rate cuts. There we go. Now that we finally got that first interest rate cut out of the way there in September, we have 2 more Fed meetings here throughout the year. Actually, the Federal Reserve will meet in their FOMC meeting tomorrow. So we'll find out again kind of what their thoughts are. Looking at the Fed fund futures, Phon, I don't know what you saw, but I think today I took a peek at that, and there's roughly a 98% probability baked in that we'll see another 25 or a quarter of a percentage rate cut again tomorrow.
Okay, that's surprising.
So at least that's what I saw. Do you seeing anything different, Phon, or what are your thoughts there?
I've been trading derivatives for like over 20 years, and everyone always looks at the futures market to kind of predict the markets, and like everything else, like sometimes they're right, sometimes they're not, but it is like money's being bet. But my best guess is they're not going to cut, because they did 50 already, and they have to figure out, we have, obviously, we had an election, have to figure out what the policy is going to be. And also, if you looked at the markets, had a chance to look at the markets, Treasury yields spiked up overnight, and when the Republicans won, because the Republicans, I'm pretty sure we'll have a lot of questions there in QA, but the Republicans are more growth, so yields have gone up a lot. So I don't think the Fed should cut, and if they cut, and then the Republicans really hit a pro-growth strategy, then yields are really going to spike up, because the bond market's going to be concerned about growth and inflation coming back. So even though the futures market is pricing in a cut, I don't think and hope that they don't cut. But I've been known to be wrong. So yeah, we'll see. So yeah.
Phon, in your experience, have you seen when those future markets are forecasting a cut that the Fed does something completely different in their FOMC meeting? Or how accurate, I guess, do you feel like those future markets are?
It's I don't think it's that accurate. Yeah. It's 50-50 most of the time.
Yeah, because it's complete speculation, right?
Yeah.
Yep. So we're completely betting. Okay, this was put this slide up here. This might be kind of hard to see, but kind of like like Phon's talking about right now. This is the future forecast for potentially, based off of that federal futures market, what we could see interest rates look like all the way up through 2026. So
Sorry,
again,
Ryan, because if you had this chart last year, every month it was exactly the same as this. The market was pricing a lot of cuts last year, and they never came. So this chart was like that last year, almost every day. So, so
good example
Yeah,
of
yeah.
complete speculation, right? So now I think we're going to get into a topic where most of you are probably interested in talking about, and that's going to be the election. I'm sure most of us stayed up relatively late last night watching in the voter results come in. And two things, Phon and I are not here to discuss individual political preferences or anything like that. We're not going to debate with you or anything. But we do want to get into just some historical data and maybe some things to think about based off of last night's results. I mean, I think we're still trying to figure out what's going to happen in the House, or at least last I saw, I don't think we have any.
Trump Republicans won, right? Correct. That's not sure.
Yes. Yes.
Because I was joking with someone like we were preparing for another presentation I have in New York. We were joking like we wouldn't know, right? Like it would be potentially be so close that we wouldn't know like 2-3 days before. But I think it's rather decisive. From what I can
And the
tell.
Republicans do have the Senate as well.
Okay.
Yeah.
So
This graph here to orient you a little bit to what you're looking at right now here. Along the left-hand column, you're seeing 4 historical years where we had the best S&P 500 returns during election years specifically. So you'll see 1928 was this is through the first 3 quarters of the year, what these numbers are reflecting. So 24.5% in 1928, 23% in 1936, and then year to date, that's what that says there, but this is through the end of the first 3 quarters of 2024, we had a 22.1% return, and then 1980 at 21%. So really just a graph showing, this is an election year, and there's been a lot of rhetoric and talk around how that's affecting the stock market, but we have had a really positive year historically in the equity markets. And then if you look towards your right-hand side of the screen there, that's average election performance the last 3 months of the year. So, we're into November now, and historically, if we look back all the way to 1928, on average, in November and December, we see in election years a positive return, typically close to around 2%. So, Phon, would you add anything to that or thoughts on that?
No.
The next chart is also kind of to what Phon mentioned there before. Is it's important who's in the White House, right? We're not trying to say that it's not, but for the most part, the stock market does not really care one way or the other who's in office. So the chart that you're looking at right here, to make it really simple, is each bar represents a presidential party that's in, red being Republican, obviously, and blue being a Democratic president in office. And this goes all the way back to 1926. And you'll just see the stock market continues to go up no matter who's in office. So just keeping that in mind and within that scope. So
Yeah, and I think like I've been really fortunate to live and work around the world, and the U.S. economy and the U.S. United States Americans. Yeah, Americans are, which I consider myself American, are the hardest working, innovative people in the world. So that's basically a reflection of that. So we're in a good place. The U.S. economy is still the strongest and most innovative. So that's more a reflection of that than whatever president we like. And all the work that I think you guys are part of the greatest generation have done, that's more a reflection of that. So
that's good.
Clicker work.
It's finicky. It doesn't like me. Okay, we'll talk a little bit. The other market mover, or things that we're paying attention to, and Phon and his team pay attention to, is just not only what's going on in the United States, but what's going on globally and geopolitical events. We've probably all seen in the news and the headlines what's going on in Israel and Hamas, I guess. I was curious if, Phon, if you had any thoughts around how what's going on over there affects the energy market and also oil prices, and then oil prices directly affecting what we pay at the pump.
Mm-hmm.
What are your thoughts around that? Or
I think right now it's a small effect. The bigger effect is back to like a large economy like the U.S. in terms of the demand. So right now it's a minor effect. I think the larger geopolitical risk is unfortunately China. As you guys know, see all the headlines. China wants to or needs to become a superpower and compete with the United States. That's the more long-term play. You know, they might invade Taiwan or might have to invade Taiwan. So I think that's the bigger long-term issue, unfortunately.
Yeah.
Can Hans speak louder? I'm just getting back here. I'm beginning to think I'm losing my hearing.
Oh, I'm sorry. Can you hear me
There you
now?
go, better.
Yeah, my bad. Sorry about that.
I have an excuse. You don't have.
I
You don't have an
sorry.
excuse. Okay, this chart here, just to kind of show you a little bit of, again, historical data around geopolitical events and wars and things like that. On the left-hand side, you'll see historical events. You'll see Pearl Harbor. You'll see the Cuban Missile Crisis, the Iraq War, and then at the very bottom row, you'll see Hamas attack on Israel. And really, without going into all the detail of what you're looking at right here, the message I want you to hear is really staying the course pays off, because as you move to the right of this chart, it may be hard to see for everyone, is that the equity market or the stock market in general rewards you for staying invested and not making emotional decisions based off of what we see in the news and the headlines. So next, we're going to talk a little bit about, now that we've covered what's happened in the first 3 quarters, we talked a little bit about what may happen here in the fourth quarter throughout 2024 and maybe into 2025, is just some things you guys can consider, things to think about, maybe ask Kathy and the team there. And the first slide that I want to show, and I'm going to give some statistical data here. Stay with me. I promise I'll sum it all and bring it all together. So stay with me on this. But there have now been, throughout year to date, through where we are right now, 41 all-time closing highs for the S&P 500 in 2024. And we're on pace for, one of the best years on record, especially in a presidential election year, as we saw on some previous slides. But in the third quarter alone, just looking at purely the third quarter, the S&P had a return of 5.9%. Okay. That is, like we saw on the previous slides, one of the record years on that. If you're not familiar with what's on the screen here, the Magnificent Seven, NVIDIA, we've already talked about a little bit, is one of those 7 companies. But the Mag 7, if you hear that term thrown around or seen in the news, we're talking about Apple, Amazon, Facebook, or now Meta, Google, Tesla, and NVIDIA, as we talked about before. Now, what we're seeing here, or what you're looking at, is that in the third quarter, that 5.9% was not really driven much by these companies. Throughout the course of this year, and even in previous years in 2023, these 7 companies have really drug up the majority of the performance that we've experienced in your portfolios, in your accounts. But what we're starting to see now is a divergence in that. We're starting to see that more companies are doing a little better. And actually, in the third quarter, these 7 companies only attributed 0.5% of that 5.9% return. So again, the other 493 companies in that index are driving more of the returns. What's the message there? What should you take from that? Is diversification is important. Kathy and her team do a really good job of making sure when they look at your portfolios that you're really well diversified. That's an important aspect, especially in retirement. So, Phon, anything that you think needs to kind of be added there? What are your thoughts?
No, that's good.
The next is Kathy. You heard her when she got up here, talked a lot about the importance of tax planning. And it's maybe more important now in the stages of most of your life right now versus for maybe me and Phon. But one strategy that we help Kathy and the team do here at the home office at AE Wealth back in Topeka is what we call tax loss harvesting or tax optimization. Putting it very simply, what we help them do or trying to identify from a tax planning standpoint is, are there positions in your portfolio that have run up and look really good in your account? And are there maybe some that aren't doing so well that we can make some efficient tax management decisions on that. Simple example, if you're not familiar with what tax loss harvesting is, simple examples, if you have a position, a stock, an ETF, whatever it might be in your account that's up $3,000, there's gains in it, $3,000 in real dollars. And you have another position that's down $3,000. What we can do is sell those positions, offset that, and when you sit down in April and look at your taxes, we can offset what you are going to potentially pay in capital gains tax. So there's a lot of historical and empirical data that shows when you do that on a daily basis, which is really difficult to do. We have a whole team at the home office in Topeka that monitor these types of accounts on a daily basis, not just once a year or once a quarter. We're actively looking for those opportunities within your portfolios and within your accounts. And there's a lot of data that shows that, that can actually help after tax performance. The old adage says it's not what you make, but it's what you keep actually in taxes. So, Phon, anything you would add on that front, or because I think I'm getting ready. I think I'm getting ready to hand it over to you.
Okay, I'm good on the taxes. That's good, Ryan.
Okay, so Phon's going to get more granular, really, on how he manages money and some things that his team does. So I'll hand it over to you if that's all right.
Yeah. So one of the core things we do is focus on risk. So like Kathy and Ryan mentioned, we like early in my career, I worked for large insurance companies and banks and managed multi-billion-dollar portfolios. And when you see the headlines where Goldman Sachs or Prudential made a lot of money in the quarter because of volatility, usually because of teams like myself, trading exotic options and taking advantage of volatility. Always in the back of my mind is like, how can I take everything I learned and apply it for advisors and their end clients? So that was one of the big reasons why I started Veta. And we try to take all that we learn from managing these large institutional accounts and apply it in your portfolio, which is my portfolio, because I have my money invested in the same strategies. The biggest thing, which this chart tries to show, is it's kind of blurry. But if you put like $100,000 in the S&P in 2007 and in 2022, and you got all the up and all the down, you end up around. The chart looks kind of wonky. Oh, you end up around 300,000. This is updated. But if you got like 75% of the up and 75% of the down, you would actually be ahead. And I think in the next slide, Ryan will kind of talk about why you're ahead. Flipping. Yeah. Oh, that's a.
That was Phon right there.
Yeah. Oh. Yeah.
Oh my gosh.
A lot of anticipation for this slide.
Got it.
The biggest reason why is the best example is if your portfolio is down 50% or your stock's down 50%, how much do you have to make to break even? Any quick guesses? Don't want to get too mathematical. Any guesses? No one? You have to make 100%. That's a lot, right? So similar, like one of Warren Buffett's secret is not to lose when the market's down. And that's our strategy. Like a lot of institutions like to lose less when the market's down. Because if you lose 50% or 40%, you got to make up 100% or 60% just to get break even. So if you lose less than the market, you're ahead. And then your portfolio is in position to buy, which is what we do. We position our portfolios where we always lose less when the market's down. And then we have cash, or we have some other strategies to generate cash to buy stocks when they're cheaper. So if you do that systematically, that's kind of what Warren Buffett does. You're going to end up much better in the long run, and you have a much smoother ride, less sleepless nights. So that's what we focus on. That's why institutions focus on risk management. So that's the graphic kind of shows that. Is there a manual one? Oh, there it is.
There we go.
And this chart is, right now everything's good. We're in a bull market. This is chart, just a reminder that eventually we're going to have a bear market. It just shows some of the historical drawdowns in the past 50 years. We have the Russia financial crisis, Black Monday, global financial crisis. So just a reminder that, you have the good times and you have the bad times. And like when I studied, and the best managers show the real alpha and performance when things are getting very volatile and bad. And that's what we're set up to do. When things are good, we're still going to do good. But when things get very bad, that's hopefully when my team and I really shine in your portfolio and really provide that balance. So that chart's just a reminder of eventually we'll have a bear market and eventually things will be bad again. But due to the U.S. economy, we'll fight through it. But we have the ups and we have the downs. So yeah. Next slide there.
Somebody needs to fire the clicker guy.
We're going reverse. So I'm not sure if Kathy has talked to everyone about buffered ETFs or defined outcome ETFs. I'll talk about it really fast. So these products came out in 2008, 2018, 2019, but they're very unique instrument. So they basically give you upside potential, like to a cap. Like you can get 10 or 8% or 14% upside, but you're able to protect 10 or even 20% of your downside. So these are buffer ETFs. So we incorporate these ETFs into your portfolio. We understand how they work. So my team and I are one of the largest allocators in the United States. We manage about 1.5 billion dedicated to buffer ETFs. A lot of these use options, very similar to the options in annuities. So we have a lot of expertise in them. So using that in the portfolios really give our portfolios a balance. Losing less than winning more. So we use buffer ETFs a lot. Another analogy is, I'm sure there's some football fans in the audience. Are there any Giants or Jets
We had some
fans?
Giant fan, I think,
Yeah.
over here.
Yeah, I feel for the Jets and Giants fans. Sorry. Ryan and I we're always spoiled. We're in Kansas, Missouri, so we've been spoiled with Mahomes. But yeah. Yeah. Another analogy is quick pop quiz. Like on average, what's the highest paid position in the NFL? This is on average. Any guesses?
Probably the quarterback.
Quarterback.
That would be the logical. That would be the logical. Oh, she's really close. So on average, the most paid position is the left tackle. What was that? Yeah, I gave you guys the cue. Yeah. Yeah. So why is the
Sorry,
left?
I'm in the way, aren't I?
Yeah. Exactly. Yeah, because most quarterbacks are right-handed, so you want the left tackle to protect your most valuable position, your quarterback. That's another way of thinking of buffer ETFs or our Veta strategies. Like we're gonna protect the blind side of your portfolio. So we have a small allocation or 30% allocation to Veta strategies. We're kind of like the left tackle protecting your portfolio. So that's another way of thinking of buffer ETFs in our strategies. So yeah.
I think the next screen is I think it's your abs.
Yeah, this is so we're close to holiday time. So I go to my wife's parents for Christmas, and holiday. There's a lot of eating and watching TV, and I was thinking like, what graphic can I do for these presentations? So I came up with this graphic. So everyone wants a six-pack. Your a fit portfolio. Yeah, our traditional portfolio is like a two-pack. You have stocks and bonds. So our portfolio is like a six-pack. We have the buffer ETFs. We have the defined outcome. We have a little bit of gold. We even have a little bit of Bitcoin in there sometimes. We have commodities. So we're a more truer, diversified portfolio. 2022 was a really good year for us. There was a bear market in bonds and stocks. Many portfolios were down 15, 20%. I don't think anyone from compliance is here, but we were down much less in 2022. So that's due to our six-pack strategy. That's another analogy, six-pack and tackle. Those are the two analogies I'm going to give you tonight. So that's the graphic. Hope that helps out. This is just a chart of interest rates. I actually think interest rates are going to go back up. You see the election yields went back up. It's because you step back 20 years, China was the lowest cost manufacturer, and they would do things very cheap. And now China is a high cost manufacturer, and with COVID, things have changed. The supply chain has changed. So structurally, I think the global economy is at a higher inflation level, and combine that with the Republicans being elected, that's gonna with their pro-growth policy. So I actually think interest rates. We've had like a nice run of interest rates the last 20 years. I actually think interest rates gonna go up in the long run. I think we kind of gonna go back to the 70s when interest rates were 10%, and that's kind of hopefully gonna reset the economy. That's kind of my long-term view on interest rates. Yeah.
I think we're gonna open it up for Q&A.
I think also before I forget, Kathy, I brought some Yetis, which hopefully we can hand out. I bought about 25 to 30 Yetis, and please email Kathy and team if you want some Yetis. We can ship them. Apologies, I can't bring any more. But the last analogy is Yeti. Like I always like giving out Yeti stuff because they're very famous to be very tough, and I like their slogan where they can withstand a bear market. So like I like giving out Yetis, like versus like your glass cup is very pretty but can shatter very fast. So we like to think of our portfolios as Yetis. So hopefully we can hand out some Yeti cups later. So sorry, go ahead. I think you're ready for questions.
Yeah, how do you guys want to do? Or do you have some from the live stream you want to start with, or just open it up to the audience? Okay. Yep. Got it. Thank you. Yeah, go right ahead, right there.
I might have missed something, but what is the relationship of Eddie
Veta, yes.
Veda to AE Wealth?
Good question. We're a third-party money managers. Some of the founders of AE Wealth helped me start Veta 4 years ago, so I think that's a big relationship. Other than that, we're pretty independent. We manage money for other insurance companies and other institutions, but I think the core relationship is the founders of AE Wealth helped me start my company 4 years ago. Yeah. Does that help?
So at home, if you didn't hear the question was, what is the relationship between the back office, AE Wealth Management, and Phon and his team at Veta Financial? And Phon kind of took that. So we act for Kathy and the team. We're a back office platform, a wealth management platform that gives her and the team access to a lot of different services or products or investments that they may not be able to get on their own. And Phon and his team and the portfolios that they run are one of the asset manager partners that we have that are available. Go ahead, Kevin.
Can you tell everybody how many portfolio managers we actually work with? I don't think people realize what we have.
A lot. The question was, how many portfolio managers does AE Wealth Management have on our platform? I would say it's getting close to the hundreds. I mean, there's a lot of ETF distributors. There's a lot of layers to when you throw the term out money manager, but there's a lot of different partners that we have. And without a doubt, Phon and his team at Veta Financial, I mean, there's just a lot of things, especially for you pre-retirees, the retiree demographic. What they're doing is very specialized in that space and just makes a lot of sense for, at the very least, a portion of a portfolio. Would you agree?
Yeah, definitely. I think I want to clarify. I think it might help everybody. So what our relationship is in this whole situation is when you come to visit with us, all of you have taken a risk questionnaire. It used to be called Riskalyze, now it's called Nitrogen. And what that does is it helps us to determine what is your capacity to risk. In other words, how comfortable are you with things going up and down? Where is your breaking point where you're going to jump off a cliff? That's what we want to find out. So we really dial in very specifically by using numbers, your dollars and cents, not words like conservative, moderate, aggressive. Those are just very subjective words. We want to really dial it in and ask you, hey, if your account went down $100,000, how would that make you feel? Okay, so you've all taken this quiz. It's all been a digital quiz. And it's all relative to how big or small your portfolio is, so maybe how much that you can tolerate. If you have the millions, maybe you say, oh, 100,000, I don't really like it, but I'll be okay, it'll go back up. Maybe you're the person that has a smaller portfolio and you'll say, no, that would be devastating. So the first step that we do is to try to determine what is your risk score, right? We call it almost like a speed limit. Now, once we know what that risk score is, that you've told us how you feel, then we look at what you had or have currently with other places and say, you know what? You say you feel like this, but you've really got this. And then we say it's time to reposition and put you more in alignment with how you say you feel about risk, not what you think you might have. Now, how we do that is every single one of the portfolios that we have access to through AE Wealth has a score, has a risk score. And that's why we choose to be on that platform, because as individuals, small fry companies, we don't have access to hundreds of portfolio managers. They do. They have vetted all of these different portfolio managers that all have very, very different and unique objectives. And then they put them on the platform, and we as your advisors get to match it up with what your risk tolerance is to what this particular portfolio has as a risk score. That makes sense? Is that helpful? And so oftentimes we can do combinations of things. You know, you've maybe heard me say many times is go more aggressive with your Roth account, right? Go all in. Why? You don't have to take the money out like you do with IRAs. You know, most of us have the bulk of our money in IRAs. But with Roths, you don't have to take the money out. So maybe you can handle it going up and down a little bit more because you can just leave it alone if it goes down. You don't have to panic or take an RMD. You know, you can just let it be. So you can use combinations of portfolios that get to the ultimate score that you tell us, I'm comfortable going 50 miles an hour. And then we know where your comfort level is. And when we very rarely, honestly, get the phone calls to say, oh my God, what are we doing? Very, very rarely, because we've kind of conditioned you to say, look, we're diversified. You know, we stay the course. We're not going to be reactive. We're proactive. We're not reactive every time we have a market downturn. You know, we stay the course. And that's where our team at AE Wealth comes in and helps us to vet all these individual portfolio managers and put them on our platform. Does that help?
I think that was
Like
great.
kind of pull it all together?
Yeah, we have a question from South Carolina.
Okay.
Why does Warren Buffett hold so much cash right now?
Because he's freaking rich.
I was
you answer
going to say, I don't know,
Yeah,
you want to take a stab at that?
I can answer that. Because he's gotten so large, he can't like a lot of institutional investments will short or like so like he can't short because he's so large anymore. So that's one of the reasons he's raising cash, and like he's more cautious these days. I think he's kind of missed out on the rally, but that's again back to his philosophy. He wants dry powder to be able to buy when the market ever dips. But I think he's probably holding on a little bit too much cash these days. I think he has like what's the number, like $500 billion of T-bills. So yeah. So I think he's cautious on the markets, so he's missed a lot of the rally. So that's his way of being cautious, preferring T-bills.
Yeah, go ahead.
Yep.
So we're told to stay the course in the stock market a lot. And what I hear on financial radio, the stock market is overvalued. Is the stock market overvalued? Staying the course, and we're going to cash, better alternative? Help me there.
Yeah, so the question was, we're told a lot to stay the course in the markets, right? The question also was, is the markets overvalued right now? Should we be paying attention to that? Does it maybe make sense to go to cash? Was that fair enough there? Phon, do you want to chime in?
Yeah, that's a very good question. That's why I like the buffer ETFs or the FINOC ETFs that I talked about really briefly, because there you're able to get some of the upside, but you protect 10 or 20% of your downside. So you don't have to make the Warren Buffett decision of shifting to cash and potentially missing missing a big move. So that's why I like diversified strategies and defensive strategies. Because no, that's a very good question. That's the age-old question.
To maybe build on
Yeah.
that, there's at least when we talk on the phone a lot with Kathy and the team, is if you make the decision with your portfolio to go to cash, you may feel good about that decision now, but the hard part is when do you get back in? And we've got a lot of asset managers that I'll say we use the term they're tactically managed, and they're buying and selling and trying to get in and out of different asset classes at different times. They're trying to time the market. There's a ton of studies. There's a lot of empirical evidence that shows that's a losing proposition. You could do a quick Google search and find that out. What is great about what Phon and his team do is the way that there's kind of a mechanism built in. So Phon and his team they're doing some things underlying, but they're not buying, selling, getting in and out different asset classes. There is that option buffer that's built into, there's a more defined outcome, or that you know what you're going to get versus just trying to buy and sell, get out and speculate.
Ryan mentioned that every one of our portfolios has a cash component.
Yes, Kathy wanted to mention every portfolio that you all own, every portfolio at AE Wealth Management has a cash component to it. It has a cash holding inside of it for a lot of different reasons. Some portfolios might have a larger cash position than others, but all of them do have a cash position.
Good question.
Go ahead.
I have a two-part question. Just to piggyback off of what Kathy said, in terms of cash, how does it vary in terms of what each member has for cash?
Yeah, great question. The question was to build off of what Kathy said on having a cash position in the portfolios. Does it vary? Do all of them have very similar cash positions? It probably starts with how we define cash, because the terminology we use in the home office is there's cash and then there's cash equivalents. So some asset managers will look at T-bills or treasuries, money markets, CDs. So some things can be categorized as cash equivalents, or you have true cash, which typically, like in portfolios, are a money market fund is typically what that'll be. And I would say it ranges, this is very generally speaking, will range from 1% to 3% most of the time for most portfolios. There are some anomalies to that, but for the most part, you'll always have that as a cash position.
And the other thing which reminded me, like cash T-bills are pretty high. I think you can get 4 to 5%. That's the other reason why Warren Buffett owns so many T-bills, because historically getting 4 to 5% on T-bills is not too bad.
That was a good question. You said you had a two-parter. Did you have something built on? Yeah.
Yeah, so in the same vein as timing the market, I guess, bear versus bull, if we're all kind of staying in the game, what difference does it make in terms of bear versus bull market? And historically speaking, does it vary from quarter to quarter? Is it year over year? How do the markets differ?
This will be no, great question. This will be your wheelhouse, so I'll let you take this one. But to repeat the question for at home, to repeat the question, it is what's the difference if we're staying the course? We're being told to stay the course. What's the difference with a bear market? What's the difference with a bull market, and how does that maybe impact the portfolio as a whole? Did I sum that up? Okay.
Right.
I think for at least how I define so the question is how to define a bear market and a bull market? Sorry.
Not to define it, just in terms of everyone's portfolios. If we're all staying in the market, how does that really impact the portfolio overall? Bear versus bull, and then just like from a historical perspective, how does the bear versus bull actually play out? Is it quarter to quarter? Do you see it more year over year?
Yeah, okay.
Year?
Okay, no, that's a great question. Yeah, I see it more year over year and longer time frames. Like the biggest thing about trying to prepare your portfolio for the next bear is like I'm sure many of you lived through the global financial crisis, right? Where the market went down 50%. So I kind of lived and traded through that. So whenever we construct a portfolio, we always try to prepare for that and make sure our portfolios can handle that and lose the least amount going into that type of bear market. Because if you do, that becomes very emotional. If you're down 50% in your 401k and your portfolio. So we always try to avoid that. That's kind of one of our benchmarks for when we run our scenarios. So avoiding a large drawdown like the global financial crisis, that's a big goal of ours. Because if you can lose less, ideally, if you're down 20% or 30% and the market's down 50%, that's where you can, deploy and buy cheaper stocks, and then eventually, you eventually have that rise up. That's how we try to construct our portfolio. Because if you get kind of like we talked about, if you get that full up and down experience, it's very emotional and hard to stomach. So we really try to get that middle ground and give you that smoother ride. Does that help a little bit? Okay, sorry. Yeah.
Thank you.
Yeah. Oh, these are very good questions. Yeah.
You mentioned the six-pack strategy, that gold was a part of that
Correct.
strategy. Does real estate also play a part in that, or is that just automatically included in your portfolios?
We usually don't include REITs or real estate investments, mainly because most people own homes and they already kind of have a real estate asset. So our strategies, we usually try to leave that out. Makes sense.
One more question.
Sure.
You mentioned NVIDIA and the successes that they're having. I read an article about successes in Australia with hydrogen cell cars. Are you looking at that or keeping track of that? Or is that way in the future?
Yeah.
Hey, Phon, real quick.
Okay.
So the previous question around real estate is real estate incorporated into what Phon and his team do? The answer was no. You kind of heard his answer there. And then the second question was, we talked about NVIDIA, and you've been reading up on
Hydrogen cell technology in cars. They're having successes in Australia with it, supposedly.
so hydrogen cell technology in cars and what success is being had in that front, on that front in Australia. So I don't know.
Yeah, actually, I analyzed some hydrogen for a advisor and client recently, but specifically, that's kind of the next generation is new energy. As you know, what powers the world and the economy is energy. I was just talking to my coworker. So we got to find the next power source, which could be hydrogen, or I think there's been a lot of work on nuclear fusion. A lot of investment has gone into nuclear fusion. So that kind of would be the next step for the economy is a alternative energy source like hydrogen or nuclear fusion. But as you know, there's a lot of competition and a lot of upstarts, and you could hit the home run or you could unfortunately lose all your money in these investments. So does that help?
Do the oil companies kind of push that aside to everybody?
I'm sorry, what's that?
Do the oil companies, the oil companies certainly want to keep the economy based on oil technology.
Correct.
As opposed to fusion or hydrogen.
Mhm.
So,
I think a lot of the headlines I'm reading, like a lot of the smarter oil companies are starting to invest in new energies and new renewables. I think they see the picture.
The writing on the wall. Yeah.
They're writing on the wall. So, yeah.
Go ahead, Brian.
I've got a couple from the live stream.
Okay.
First one, should we be buying non-magnificent 7 ETFs?
Question is, should we be buying non-Magnificent 7 ETFs? I'll just start by saying, yes, you should. It goes back to that conversation of being diversified, back to that chart. We just saw in the third quarter how those 7 companies didn't do as well as the other 493 companies in that indice, which again just lends itself to don't have all your chips in one basket, or not all your eggs. Don't have all your eggs in one basket. Sorry, I did a stint in Vegas here recently, so chips are on mine right now. So yeah. Anything you want to
No,
from there?
that's good.
The next one is, if interest rates rise, what will happen to the S&P 500?
Question is, if interest rates go up, what will happen to the S&P 500 index?
Yeah, that's a good question.
That's a great question.
I think the better way to look at it, if interest rates rise faster than inflation, which is called the real rate, because if the nominal interest rate is 4% and your inflation rate is 2%, so the real yield is 2%. So historically, whenever the real yield goes above 3, that's going to cause the economy to go in recession, which we track. So eventually, if interest rates go up higher than inflation and the real yields go up, that's going to slow down the economy. So if that keeps going up, the economy has to slow down because mortgage rates and everything goes up. So that should naturally slow down the economy.
And then the last one so far I got on here is, can you give us an example of popular beta fund thresholds?
The question is, can you give examples of popular Veta strategy thresholds? Is that correct?
In terms of asset allocation?
Like in terms of the buffer, maybe, or the buffer? Yeah.
Oh, like historical buffers? So like historically, you can protect 10% of your downside, and your upside is around 9 to 15%. That's called a 10 buffer. And the 20 buffer, you protect 20% of your downside, and historically, you can get around 7 to 14% of your upside. Hopefully that helps in terms of thresholds. So, yeah.
What else? Yeah.
What do you both like to use in terms of researching for emerging markets? Are there any specific areas, sites?
The question is what do we like to use for researching emerging markets? I'll go first and just say we use a lot of different tools and softwares at the home office, like names you may have heard of, like Morningstar, Bloomberg. There's software like FactSet are some that are out there that we utilize to do analysis, at least it's what our investment committee uses those tools. So.
I just want to say, Kathy, you have one of the most inquisitive groups I've ever encountered. So, yeah. I thought I handled a lot of questions before a lot of these events, but like, most of these questions are new. So, no question on Bitcoin was surprising. And usually there's a question on Bitcoin. When you talk about emerging markets, you're talking like countries outside the United States?
Yeah.
Okay.
Any sort of new technologies that you might be, even energy. I know there's a lot in terms of emerging markets.
Yeah, in terms of me, I use Bloomberg, but I think the biggest thing is like getting outside of my office and house and like hitting the road and seeing technologies and meeting people and visiting other countries if you have the opportunity. That's what really kind of combines the analysis on Bloomberg or Morningstar with the kind of the hands-on research. Yeah, boots on the ground. Yeah, and like it's been great. I gotta write down some of the questions you guys asked. Some of these are ringers. So yeah, does that help? Yeah. So yeah. All right.
What are your thoughts on investing in commodities like gold and silver? Is it better to hold a physical commodity or like a gold or silver ETF?
Yeah, that's a good question. I can handle
Real
this
quick.
question. Yeah.
For at
Okay.
home, the question is, what are our thoughts on investing in commodities? Also, not just commodities like publicly traded gold, silver, but also like the physical, like gold bars, silver. That fair?
Yeah, I think every portfolio should have an allocation to commodities. Gold is like a special commodity because it's also a currency. I've had a lot of experience investing in gold in my life and career. I've invested in gold futures, gold companies. When I was in Saudi Arabia, we've owned the physical gold. So I think everyone should consider an allocation to gold and physical gold. Bitcoin is like a digital version of gold. I think back to what Ryan and I've talked about. Hopefully, it's like I think the more you can diversify your portfolio, I think the less you have to kind of worry about getting in and out the market. If you have a really diversified portfolio with annuities and buffer ETFs and gold and real estate, I think that's on a long-term plan. I think that's
I also
better.
wanted to say
Yep.
something about this.
Yep.
Because I saw it on the news last night when we were watching the election and whatever. Buy gold, inflation's going out of control, this is it's falling apart. What you have to remember is a lot of these things have an agenda. They just want you to buy gold, okay? You have to read through some of these things that you see on the internet. They all have an agenda. So just be careful of that. Just because they say it doesn't mean it's true, all right? And that's why we have various different money managers that have all different investment strategies. So it's not just one strategy. But just be careful of what you see on the internet because a lot of it is just propaganda, all right? Trying to protect you.
Yeah, I would definitely agree with Kathy.
Yep.
Yeah. Yeah. And, limit any gold or commodity holdings, generally 5% or less of your portfolio. Does that help?
Yeah.
What keeps you gentlemen up at night?
What was it? Sorry, what was the question? My children. I have a 10-year-old, 5-year-old, and 2-year-old, and those are exactly who keep me up at night. Do you want to take that? You want to?
Yeah, luckily I sleep pretty well at night. Like my goal is always to get our portfolios, another saying, tab where I can sleep comfortably at night and our clients can sleep comfortably at night because we have all our diversified hedging solutions. So I actually I sleep very well, and we actually hope for volatility, hope for opportunities. We like it when things move around. So I sleep fairly well. So yeah. So, yeah.
Any other questions?
Okay. Well, thank you all again for letting us be a part of this. Kathy,
Thank you,
team,
guys.
thank you
Yeah.
guys very, very much.
I think we got some Yetis back there. So.
There is something here.
Oh yeah.
And we're going to hang out for a while, so if you guys think of questions, come track us down.
Yeah.
So, what specific incident caused the offensive
Excuse me.
lineman to be paid the most? Do we know?
Good question. Probably quarterback injuries, I'm guessing.
Right.
Yeah.
Specifically, you know?
You probably know. Yeah.
Because when they were the question about the left,
Feel good about it?
So
That was good though. That was good engagement. That was good.
Yeah.
such a big thing, because that's what that movie, The Blind Side, is about.
Oh,
Like
okay.
with Michael Orr. But I think it was Joe Theismann. Remember when Joe Theismann was, you know?
Oh wow.
Okay, so remember when he.